Advice 7. Value investing is the key. Look for remarkable companies. These companies must be operated by managers who prioritize shareholder interests, and their stock prices should be attractive without overvaluation. In the first chapter, we emphasized that Warren Buffett always approaches stock selection as a business investor rather than relying on stock price fluctuations to determine whether to buy a particular stock. He dismisses such speculative practices and holds them in contempt. Buffett fully embraces the principles of value investing, consistently placing the intrinsic value of a company at the forefront. He never expends excessive energy on stock price volatility, which he considers meaningless in the long term. When explaining his stock-picking principles, he often says, in the short term, the market is a voting machine, but in the long term, it is a weighing machine. Therefore, only companies with genuine growth prospects are worth owning. Through value assessment, Buffett avoids purchasing companies lacking potential or those already labeled as for sale. Based on intrinsic value, he selects outstanding companies that lead the field. Additionally, the management teams of these companies must be committed to ensuring the company's continued smooth operation. It is this value-oriented approach that has made Buffett triumphant, invincible, and risk-averse to stock price fluctuations. Section 1. Keen insight and seizing opportunities. Warren Buffett once said that the most important lesson in stock market investing is how to evaluate a company and its market price. The ability to identify outstanding companies among many is crucial for successful investments. While most stock investors are still searching for needles in a haystack, you can gain an edge by identifying excellent companies early and entering the market ahead of others. The importance of selecting outstanding companies cannot be overstated. It's akin to being a skilled horseman who recognizes exceptional steeds. Business logic. Through continuous study of Warren Buffett's approach, you'll discover that he resembles a collector, a discerning one at that. Unlike wealthy individuals who collect art, mansions, antiques, yachts, and other extravagant items for show or status, Buffett specifically collects companies with growth potential. Throughout his life, he has spent considerable time seeking out good businesses to invest in, and these exceptional enterprises have made him a shining star in the stock market. People have summarized Buffett's investment principles as follows. B. Seeing oneself as a business operator. Xinghao Buffett considers himself an operator of the businesses he invests in. This mindset ensures that he evaluates companies from an operational perspective. Xinghao, by assessing a company's intrinsic value, he aligns his investment decisions with its actual worth. R. Emphasizing good companies over good prices. Xinghao Buffett consistently prioritizes the quality of the business over the stock price. Xinghao, he focuses on companies with competitive advantages and economic moats. 3. Pursuing monopoly-like businesses. Xinghao Buffett is well acquainted with industries characterized by monopolistic tendencies. Xinghao resource monopolies, such as roads, media, coal, and electricity, constitute a significant portion of his investment portfolio. Xinghao, these unique advantages ensure stable profitability. 4. Valuing intrinsic company value over short-term stock price fluctuations. Xinghao Buffett remains unfazed by short-term stock price volatility. Xinghao, as long as a company's intrinsic value remains stable, stock price fluctuations are natural occurrences. 5. Holding outstanding companies long-term. Xinghao Buffett believes there is never a suitable time to sell the best companies. Xinghao consistently holding shares of outstanding enterprises reduces risk and allows for capitalizing on opportunities. In summary, adopting the perspective of both a business operator and an investor, adhering to intrinsic value, and maintaining a long-term focus are key principles in Buffett's investment philosophy. These straightforward yet captivating ideas, when fully understood, can lead to successful investing. Key indicators for evaluating companies. B. Simplicity and understandability. Xinghao Buffett differs from typical investors who focus solely on financial ratios and technical analysis. Xinghao, he invests in companies he thoroughly understands and that have promising industry prospects. Xinghao investigates whether the company you're observing is easy to comprehend. Access relevant information, including business scope, registered capital, shareholders, legal representatives, company address, subsidiaries, and affiliated entities. R. Historical performance. 星号 a company's operating history is akin to a person's life experiences. 星号 analyze whether the company has maintained stable operations, faced challenges, and adapted effectively. 星号 consider any mergers, acquisitions, or regulatory compliance issues. 3. Quality of management. 星号 Buffett favors companies with ethical, dividend-focused management. 星号 a competent, cooperative management team ensures stability and value preservation. 星号 assess whether the management consistently prioritizes shareholder interests. 4. Sound financial condition. 星号 a company's financial health is essential for its survival. 星号 evaluate assets, income, liquidity, and solvency. 星号 if financial issues arise, consider exiting early rather than investing in a risky venture. 5. Sales and operational efficiency. 星号 sales directly impact cash flow, akin to a company's circulatory system. 星号 monitor sales growth and inventory levels. 星号 a stagnant or declining sales trend can negatively affect financial stability. 6. Return on fixed assets. 星号 high returns on fixed assets indicate efficient utilization. 星号 companies with effective asset management tend to perform well. 7. Future prospects. 星号 stock market returns depend on future stock price trends, not just entry and exit prices. 星号 invest in companies with promising long-term prospects. 星号 a company's ability to sustain growth influences its stock price trajectory. Remember that these indicators collectively provide a holistic view of a company. If any of these factors fall short, exercise caution before making investment decisions. Understanding a company thoroughly is crucial, and once you have a comprehensive overview, the next step involves dissecting it further. Paying attention to details can often determine success or failure. Let's delve into this big bowl of a company. E. Assessing orders and sales. 星号 if you adhere to value investing principles, you must focus on the company's quality. Only companies with good fundamentals are suitable for investment. 星号 factors affecting company quality include management, technological standards, and economic cycles. 星号 sales are a critical indicator of a company's success. They determine whether net profits can sustainably grow. Consistent orders play a key role in revenue stability. 星号 different types of orders. 星号 industry boom, pre-ordered sales in a seller's market. 星号 long product cycles, large orders to ensure smooth operations. 星号 government procurement, orders from qualified suppliers after bidding. 星号 the impact of orders on profit varies. For some companies, fixed-priced orders may be affected by rising costs. Government orders, however, can enhance profit expectations. R. Evaluating performance and governance. 星号 company performance is crucial for investment decisions. Investors should focus on sustainable profitability and effective governance. 星号 despite robust macroeconomic growth, investors must differentiate between genuine and unsustainable growth. 星号, companies with long-term core competitiveness and sound governance are preferable. 星号 effective governance includes monitoring mechanisms, reasonable incentives, credit ratings, and management integrity. 3. Financial analysis. 星号 financial health is a barometer of a company's operations. Financial statements reveal various aspects. 星号 cash flow analysis. 星号 cash flow is vital. Key indicators. 星号 cash flow ratio measures ability to cover short-term liabilities. 星号 cash dividend coverage evaluates dividend-paying capacity. 星号 analyzing cash flow sources, e.g., sales, investments, and uses, e.g., debt repayment, provides insights. 星号 profit and loss statement, income statement, analysis. 星号 focus on key metrics like operating income, net profit, and profit growth. Xinghao profitability matters more than just positive or negative net profit. Sustainable core business growth is essential. Xinghao interlinked analysis. Xinghao consider the relationship between debt management, debt ratio, asset utilization, asset turnover, and profit growth. Xinghao rising debt ratio with declining asset turnover and profit margin indicates potential financial issues. Xinghao analyzing these together helps assess profit prospects. 4. Efficiently reading annual reports. Xinghao annual reports disclose a company's operations, financials, and more. Xinghao key sections include company overview, accounting data, business details, shareholder information, board reports, and financial statements. Xinghao focusing on accounting data, financial reports, and board reports provides valuable insights. Xinghao remember that annual reports cater to various readers, shareholders, potential investors, creditors. Prioritize relevant sections for a comprehensive understanding. By mastering both the big picture and detailed analysis, you'll gain an advantage and make informed investment decisions. Section 2. Choosing industries for investment. Warren Buffett has always been keen on monopolistic companies. The companies he invests in span various industries, including coal, electricity, dining, and media. These companies have provided him with stable profits, highlighting the importance of industry selection. Buffett believes that correctly predicting the future performance of the observed industry is crucial. When assessing an industry, two factors should be considered: its historical performance and its future prospects. Understanding the historical development of an industry is essential for accurate future predictions and anticipating trends. To evaluate an industry's growth, you can compare its historical growth rate with the overall national economic growth rate. Industry growth indicators may include output value, while GDP growth serves as a benchmark. If an industry's growth rate surpasses the national GDP growth rate, it indicates strong development prospects and a positive outlook. Conversely, if it lags behind, the industry may be in decline. For precise data, regression analysis can be applied to historical data to create predictive models for industry development. However, such quantitative models cannot guarantee future industry outcomes. They merely provide insights into the relationship between industry growth and national economic growth. Buffett's industry analysis relies less on complex mathematical calculations and more on his intuitive understanding of the economy. While no model can accurately predict any industry's future development, analyzing Buffett's investment portfolio and industry characteristics reveals promising sectors. Firstly, Buffett favors consumer monopolies, especially in the United States. Consumer spending drives economic development, making stable growth in consumer-oriented companies evident. Generally, any industry dominated by monopolies or oligopolies holds superior development potential. Consider the companies Buffett has invested in. Almost all are globally renowned enterprises. For instance, Xinghao Coca-Cola is the world's largest beverage company. Xinghao Gillette holds 60% of the global convenience razor market. Xinghao American Express's cards and traveler's checks are essential tools for international travel. Xinghao Wells Fargo Bank dominates California's commercial real estate market and ranks among the top 10 U.S. banks. Xinghao Fannie Mae is one of the two major residential mortgage lenders in the U.S. Xinghao Disney, after acquiring ABC, became the world's largest media and entertainment company. Xinghao McDonald's is the leading global fast food chain. Xinghao The Washington Post is one of the most respected newspapers in the U.S., with profitability far exceeding industry peers. Buffett also shows interest in the energy sector, investing in companies like Exxon and PetroChina. As the global economy steadily grows, energy demand will continue to rise, ensuring a bright future for energy enterprises. Buffett's chosen companies consistently outperform their industry peers and even surpass the average performance of societal enterprises. This explains why he remains bullish on these companies. Buffett profits from various forms of corporate stocks. His preferred approach is to own 100% equity in well-managed, financially sound companies with favorable prospects. Alternatively, he holds partial stocks in companies with good management, solid finances, and positive outlooks. Section 3. Warren Buffett has long adhered to the principles of value investing. He has repeatedly advised investors to seek out remarkable companies and their stocks. The value of a company ultimately determines the price of its stock, making value investing truly golden. Buffett's value investing philosophy revolves around comparing a company's intrinsic value to its market price. Essentially, value investing involves buying shares of a company when its market price is significantly discounted relative to its intrinsic value. In this approach, we primarily focus on understanding a company's intrinsic value, which means identifying companies with higher intrinsic worth among the multitude of options. The concept of intrinsic value is crucial for evaluating the relative attractiveness of investment opportunities. Buffett defines intrinsic value as follows. Today, the value of any stock, bond, or company depends on the cash flows it can generate over the entire remaining life of the asset, discounted at an appropriate interest rate. However, even with this definition, investors cannot precisely or even approximately calculate the intrinsic value of a company. From this definition, intrinsic value comprises three key elements: the annual amount of cash flow, the discount rate, and the time horizon. Yet, all three of these numbers remain uncertain. Moreover, estimating the remaining life's cash flows is inherently vague and unquantifiable, as it depends on future expectations for the company, an inherently subjective process. Buffett consistently emphasizes the importance of a company's intrinsic value, but interestingly, he has never explicitly revealed how to calculate it. His explanation lies in his own words: all the numbers and data reside in my head. If an investment requires complex calculations for decision-making, it's not worth pursuing. The inherent ambiguity of intrinsic value likely explains why Buffett refrains from disclosing his precise calculation method, especially considering that he cannot guarantee its accuracy. In Buffett's view, intrinsic value remains somewhat elusive. In one of his annual reports, he revealed that if two knowledgeable investors evaluated Berkshire Hathaway's intrinsic value, their assessments would likely differ by no more than 10%. This suggests that while precise calculations are challenging, investors still have reasonable guidance. Additionally, Buffett introduced the concept of a margin of safety. It means that the investment target should not only be valuable but also undervalued. Companies significantly discounted relative to their intrinsic value, the fuzzy value, become attractive investment opportunities. In essence, this discount creates a safety margin, allowing investors some leeway in their valuation of intrinsic worth and enhancing overall investment safety. Buffett advises, you can't precisely know a simple value. Give yourself a 20% margin of error, and the reasonable value lies within that range. Buffett estimates expected compound annual returns based on his assessment of a company's intrinsic value. For instance, he predicts a company's future value 10 years ahead and then compares the purchase price to the estimated value at that time. In its simplest form, if Buffett buys a share of X company for $10 and expects its stock price to reach $50 in 10 years, he calculates an annual compound return of approximately 17.56%. He then compares this return with other investment benchmarks to determine whether the investment is worthwhile. Now, the challenge lies in finding value-oriented companies. Different investors arrive at varying conclusions based on their perspectives. However, two principles remain consistent: static investment value, comparing current market value to net assets, and dynamic investment potential. The latter, although more complex, is the allure of the stock market. While dynamic value is harder to grasp and track, maintaining a macro perspective and patiently holding onto solid stocks can lead to substantial investment growth. Section 4. Do not sell outstanding companies. Warren Buffett's successful value investing strategy relies not only on estimating a company's intrinsic value but also on the element of time. Only when a company's value appreciates in the future can your profit potential continue to grow. Buffett advises, never sell outstanding companies under any circumstances. We've emphasized this point multiple times before. Investing, rather than speculating, and having a long-term perspective are crucial. So, let me reiterate, once you identify an outstanding company, exercise patience. Unless there's a fundamental change in the company's value, avoid discarding these exceptional businesses. Becoming an excellent company requires contributions from every aspect of the organization. Employees at all levels should treat the company's future as their own, laying the groundwork for its invincibility. Therefore, when investing in a company, thoroughly assess its strength, develop a discerning eye, and observe its details over the long term. Beware of superficially prosperous companies that may be elaborate traps. Only those companies that diligently serve shareholders' interests and maintain their integrity are worthy investment targets. Transforming from an obscure enterprise to an outstanding one takes considerable time. Consequently, selecting your investment targets also demands careful consideration, meticulous analysis, and dedicated research. Remember, there are no shortcuts to success. Blindly investing without foresight and courage is detrimental. The key lies in seizing opportunities and making informed value investments.